Welcome to the Investor Edge. Imagine a company that just beat earnings estimates, grew revenue by 17.6%, and posted a 30% jump in operating income. You'd expect the stock to fly, right? Well, Netflix did exactly that, and the stock is actually down 5% after hours and 20% over the last 3 months.
It sounds irrational, Mark, but here's the twist. Netflix effectively killed its old identity this quarter by suspending share buybacks to fund an all-cash $82 billion takeover of Warner Brothers Discovery assets. They aren't the asset-light tech disruptor anymore. They are becoming a leveraged Hollywood utility.
Exactly, and that creates a massive dislocation in the stock price. Today, we are tearing apart the Q numbers, exposing the 3 biggest discrepancies in management's narrative and giving you the exact technical entry points for this new Netflix plus HBO giant.
If you hold Netflix or you're thinking about buying this dip, you need to understand why the market is terrified of this debt load and why they might be missing the bigger picture.
Let's start with the hard numbers from the print. Netflix reported Q revenue of $12.05 billion. That is a 17.6% increase year over year, coming in just above Wall Street consensus.
And for those new to the terminology, when we say year over year or YOY, we are comparing this quarter directly to the same quarter to account for seasonal trends like holiday viewership.
Right. Now, on the bottom line, they delivered earnings per share, or EPS, of 56 cents. That beat expectations by about 1.8%. Operating income hit $2.96 billion, which means their operating margin expanded to 24.5%.
That margin expansion is critical. It tells us that despite inflation, they are keeping costs under control. But Mark, we have to talk about where this growth is coming from. It's not just subscribers anymore.
No, it's not. The ad-supported business is exploding. Ad revenue grew 2.5 times year over year. Management says they expect it to double again to $3 billion in.
And regionally, the narrative that North America is tapped out is officially dead. The United States and Canada region revenue grew 18%. That matches their international growth rate.
That is driven largely by the crackdown on password sharing and price hikes. But here is the red flag on the balance sheet. Free cash flow was strong at $9.5 billion for the full year. But, and this is a huge but, they have suspended the share repurchase program.
This is the friction point. Investors love buybacks because they reduce the share count and boost earnings per share. Netflix is stopping that cash return to save money for the Warner Brothers deal. They have secured $42.2 billion in bridge loans,
which changes the risk profile entirely. We are moving from a clean balance sheet to a leverage ratio that could hit 3.9 times EBITDA.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a proxy for raw cash flow. Going from 0 leverage to nearly 4 times leverage is a massive spike in risk.
Okay, let's get into the weeds. This is where we look at what management said versus what the data actually shows. We found 3 major discrepancies this quarter.
The first one is about engagement. Management keeps talking about how strong their viewership is. They reported that viewing of branded originals rose 9% in the second half of the year. Sounds great, right?
It does. But here's the catch. Total view hours across the entire platform only increased by 2%.
Exactly. Think about that math. If originals are up 9%, but the total is barely moving, it implies that viewing of licensed content, movies and shows from other studios, is dropping like a rock.
So, the Netflix as a utility thesis has a leak. Competitors like Disney and Paramount are pulling their content back,
which explains the desperation for the Warner Brothers deal. They aren't just buying HBO for growth, they are buying it for survival. They need that library to plug the hole left by losing other licensed content.
That's a great catch. Discrepancy number 2, the certainty of the deal. Management amended their offer for the Warner assets to $27.75 per share, all cash. They claim this provides certainty of value compared to the hostile bid from Paramount Skydance.
But the market isn't buying the certainty part yet. The stock is trading at a 20% discount from its highs. Why? Because of integration risk.
Right. Co-CEO Greg Peters admitted on the call that they are worried about corporate sprawl.
Corporate sprawl is polite CEO speak for this is going to be a mess. They are trying to merge a Silicon Valley tech culture with a traditional Hollywood studio culture. Historically, media mergers like AOL Time Warner have destroyed massive amounts of value due to culture clashes. The numbers look good on paper, but the operational reality is going to be ugly for at least a year.
And finally, discrepancy number 3, guidance. Management is guiding for full-year operating margins of 31.5%. They say the business is efficient.
However, look at the Q earnings guidance. They missed the consensus estimate significantly. They guided for 76 cents EPS versus the 81 cents Wall Street wanted.
So they are promising margin expansion later in the year, but starting the year with a miss?
Yes, because of front-loaded deal expenses. They are paying lawyers and bankers hundreds of millions right now. The discrepancy here is timing. You are paying the costs now, but the synergies, the cost savings, won't show up until.
Let's pivot to the charts. If you are a trader looking at the next 90 days, the setup is tricky. Remember, Netflix did a 10-for-1 stock split in November.
Right. The stock is currently trading around $87. If you adjust for the split, that's like $870 on the old pricing.
Technically, the stock is broken right now. It is trading below its 50-day and 200-day moving averages. That is usually a strong sell signal for momentum traders.
However, let's look at the RSI, or Relative Strength Index. It's sitting at 42.5.
For context, an RSI under 30 is oversold. We aren't there yet.
Exactly. This suggests there is still room for it to fall further. We are watching a critical support zone between $82 and $85.
So, if you are a short-term trader, you do not catch the falling knife here. You wait for a test of $82. If it holds there, that is your risk-reward entry.
Now, if you have a multi-year horizon, the conversation changes completely. Let's look at the bull case.
The bull case is the super app thesis. By acquiring Warner Brothers, Netflix gets HBO, Harry Potter, and DC Comics. They combine that with their 325 million subscribers.
And crucially, they combine the ad inventory. Netflix plus Max equals the biggest premium video ad platform in the world, rivaling YouTube.
The math is compelling. If they hit that $3 billion ad revenue target in and integrate the Warner library, they could legitimately see earnings power double by. You are paying about 28 times forward earnings right now.
Which is expensive compared to legacy media like Disney, which trades at 16 times earnings. But Netflix argues it's a tech platform, not a media company.
Now the bear case. It's all about debt and dilution.
If interest rates stay high, servicing $42 billion in new debt is going to eat up a huge chunk of their cash flow. Interest expense alone could jump from $700 million to $3.5 billion a year.
That crushes net income. Plus, there is regulatory risk. The FTC might block this deal or drag it out for 2 years, leaving Netflix in limbo.
So, the long-term framework is this. You are betting on execution. If you believe they can integrate Warner Brothers without destroying the culture, $87 is a bargain. If you think this turns into another ATT and Time Warner disaster, the stock could re-rate down to $60.
So, here's the bottom line. Netflix has won the streaming wars, and now it is buying the spoils. But the transition from a high-growth tech stock to a leveraged utility is painful.
We view the current stock price of $87 as an accumulation zone for patient investors. But we would aggressively buy if it touches that technical support at $82. The long-term value of the Warner library is just too high to ignore.
That wraps up today's deep dive on NFLX. If you found this analysis helpful, please subscribe to The Investor Edge, leave us a 5-star review, and share this episode with a fellow investor. Want us to cover a specific stock? Email us at opalfinancial1@gmail.com. We read every message. We appreciate your support, and that means a lot for us.
As always, this episode is for educational purposes only. This is not financial advice or a recommendation to buy, sell, or hold any security. We're not registered investment advisors. We don't know your personal financial situation. All investments carry risk, including loss of principal. Do your own due diligence and consult a licensed financial advisor before making any investment decisions. This is The Investor Edge, produced by Opal Financial, LLC. Please reach out to opalfinancial1@gmail.com for any questions you may have. Thanks for listening.